Hello friends, this video is about sovereign gold bond scheme, and in this video we are going to cover the background part, the features, the advantages of this scheme and its comparison with the physical gold and the gold ETFs which are currently traded on the Indian stock exchanges, and the nifty returns over the gold returns. So let's have a quick background part. Gold has always been traditional source of investment in India. And you must be knowing that India is the second largest consumer of gold. Of course, the first consumer of gold is China. So, on an average, 700 to 900 tons of gold each year we import. So, you see, we Indians have always been traditionally biased towards physical assets, be it gold or real estate. So, the women and the senior citizen always look for the gold as an investment or for physical asset holding because of its low risk investment and their low risk appetite, so it is considered as a safe haven and investment. But on the individual part, holding physical asset attract risk of safety, purity, cost, and for government it is also dead investment because holding jewelry in the form of physical asset does not circulate as in money supply, so does not benefit economy and does not contribute to the GDP of the country. So it blocks the money because we either keep it at home or at bank in a locker. So it does not circulate in the economy in the form of financial saving or money. So the government has came up with the gold civil gold bond scheme in November 2015 under GMS. GMS is gold monetization scheme, which also works like a gold saving account which will fetch you interest that will depend on the weight and the appreciation in the value of gold. So you can deposit in the physical form like be it jewelry, bars or coins. So the objective behind this civil gold bond was to reduce the demand of physical gold by offering an alternative to own gold in electronic form or paper form, and shift a part of the domestic saving which was used for the purchase of physical gold into financial saving by circulating money in the economy. So the issue of SGB are made open for a subscription in series by RBI on behalf of government. So currently the third tranche is going on. So in the 2021 series, there are 6 tranches which are going to be issued. 2 of them have been issued in April and May, and this is third is going on, and 3 will be issued in July, August, September respectively. So 6 tranches are going on in this fiscal year 2020-21. So if we talk about second tranche, so it was the highest ever amount subscribed by the issuer in this civil gold bonds, and it was priced at 4,590. So now let's see the features of the third tranche which is going on and it's going to close on 12 June, and you can apply till 3:30 p.m. So make sure that you apply in this bond by the 3:30 on. It is going to close on 12 June. So let's talk about the features. So the eligibility criteria will be resident Indian entities will be individuals can apply, minor child can also apply with the help of guardian. Jointly, 2 individuals can apply. HUF trust universities, so they can apply. Minimum denomination will be 1 gram of gold and in the multiples of 1 gram. And the maximum limit will be 4 kg for individual, 4 kg for HUF, and 20 kg for trust and similar entities. So this limit will be per fiscal year, that is April to March. So if you are going to apply, the annual ceiling will include the bond subscribed in the earlier tranches or the initial tranche or those purchased from secondary market. So if you purchase 1 gram on secondary market, 1 gram in this tranche, now the rest 2 you can apply maximum because there is a limit of 4 kg for individual. Now go for issue price. So for third tranche it will be 4,627. Sorry, it's 4,677. But if you apply online through net banking, you will get a discount of rupees 50 per gram. That is, it will cost you 4,627. Now let's look at the interest rate. It will be fixed at the rate of 2.50% per annum, and it will be paid 2 times in a year. You can say 1.25 for 6 months, 1.25 for 6 months. This will be simple interest rate, and you approximately you will get 110, 55 semi-annually. The most important part is you will get the interest on 4,677 even if you apply by online mode. Now the tenure will be 8 years, but you will get the option, the window will be open at the end of 5th year, after the 5th year, to redeem it. Now you have to comply with the know your customer compliance part, documentation part. PAN number is mandatory. And now we talk about the advantages. So there is absolute safety. So it is the safest way to buy and store gold, and you can invest in this without any inherent risk and making charges cost. So this is as good as holding it in an electronic form. Extra income will be your interest income and your capital gain appreciation. So interest income, we have talked about that, 2.5% per annum. And for the capital appreciation, let's take an example. If you are an individual buying 1 gram of gold for 4,667, and at the end of 8 years the price goes up by 8,000 suppose. So the difference of 3,300 approximately, that will be your capital gain, capital appreciation gain you will get at the end of 8th year. So there are two extra income. One is interest income, one is capital appreciation income in this bond. Redemption price will be calculated in Indian rupees based on simple average of closing price of gold of previous 3 working days. Suppose the RBI is issuing the bond on today, you can say 8th June. So the 5th, 6th, 7th closing price will be taken and its average will be calculated, and that will be a redemption price. And issuance price is also calculated in that way. So the redemption price and issuance price is calculated on this method. Now tradability, they will be traded on both exchanges, be it NSE and BSE, and you can see all the earlier issuance of civil gold bonds are available on trading on NSE. We can check it out here. So here we can see 39 tranches have been issued till date from November 2015. So these all are the 39 tranches, the issue price, the issue date, and the price, the date after 5 years, because you get an early exit option after 5 years, and this is date of redemption, that is after 8 years. So these are the 39 tranches, and you can see here these are different gold prices. So these are not fixed because the gold price fluctuates every moment like a stock market fluctuation goes. So you can see, and we have seen that how issue price and redemption price is calculated. Tax treatment will be interest on this bond will be taxable, of course. There will be no TDS deducted, as TDS is deducted by bank on every interest, but here no TDS deducted requirement. And if you hold till maturity, it is till 8 years, on capital gain there will be no tax, it will be tax free. But if you redeem before 8 years, that will attract capital gain, but on that too you will get the indexation benefit. And what is indexation benefit? You can say your costs with the application of indexation benefit, your cost will goes up, and so your capital gain will get reduced. So overall you can say that if you held till maturity, no capital gain, it will be tax free. And if you redeem before 8 years, you will get your gain will attract tax, but after applying indexation benefit, it can be used as a collateral, as a loan. So you can apply by putting it as a security, and it is also eligible for SLR for banks. SLR is statutory liquidity ratio. So banks have to maintain a capital and has to retain a certain part, and only after that they can give credit to their customer. So the part which has been kept as SLR, these bonds will also can also be included in that ratio, in this ratio. So assurance of purity, of course, 999 purity is there, 24-carat purity is there, because if you're going to buy physical gold, always we have a risk of purity, but here it is purely 999 purity is there. Now if we check the gold versus Nifty historical return, guys, you can check it out here that Nifty return has been negative in 3 to 4 years, but gold has given negative return in 3 years. So we can say, we can definitely include it as a part of our portfolio for diversification purpose. So it has also given a good return. We can see here that 24% return is given in 2019, while 14% was given by Sensex, and on 3 times it has given negative return. 2020 data is not here, and you can see in 2020 we can see due to COVID-19 pandemic it is also giving negative return in 2020. So you can check it out here that it is given 31% return it has given in 2011. So definitely friends, we can include it in our portfolio. Now let's compare it. Physical gold, so return lower than actual return due to making charges, lower than actual return on gold, but due to GST application, but here it will be higher as compared to these two. Safety, of course, in gold ETF we held in electronic form. Here we also can it held it in demat form or paper form, and there is in physical we have handling physically, so there is risk. Purity, of course, there is 999 purity, there is also 999 purity, but there always remains a question. Capital gain, if held for after 3 years, you will get the indexation benefit, but if held in maturity, no indexation, as we discussed about it. Here we will get long-term capital gain, but no indexation benefit will get here. Collateral against loan, yes, we can give physical loan. Muthoot Finance, we have heard about it. No, in gold ETF we have no collateral option. Yes, we have. So you can check here, storage cost high. So it is almost have all the benefit as compared to this physical gold and the gold exchange trading fund. Now how can we buy? We can buy through post office. So not all post office, but few have been authorized for this issuance of this bond. BSE or NSE, of course, they are traded on this stock exchange and available in demat form. We can buy through Zerodha. We will check out how we going to buy from Zerodha. There are several banks. You can buy it through SBI net banking, and you will also get ₹50 discount through Shri. You can buy, and there are various other RBI website. Guys, you will generally see that if the equity is given negative return, the gold will give positive return. They goes in opposite direction. I'll show you practically. Okay, so this is money control website. So guys, not generally we see the opposite returns on these two securities. So you can check it out here that today the Nifty has given 2.12% decline, right? So there is negative return of 2.12 negative return, or the Nifty has gone down with 2.12% today. And in commodity market, that is in gold, we'll see comparatively rise in gold in 1.69%. So here you can guess that when investors fear of losing money in equity market, they rush to the commodity market or gold and buying gold and silver. So you can see the gold is working as a hedge tool that is protecting us in bad times. So gold is taken as a asset which protect us during bad times. So the basically the end is like you have to choose sovereign gold bond as your long-term investment. If you love investing in gold, holding gold as an investment option, so avoid investing in physical gold, especially jewelry, because you stand to lose 30 to 40% of its value after paying making charges and also the transaction charges, which are GST on both sides. buying and on sell. So avoid investing in physical gold. If you want to invest, do invest in several gold bond and make as part of your investment.